All right, so welcome to chapter 6.4, lower cost of market. So once again, this section right here is the last section of chapter 6, okay? What happens to inventory um, when you acquire it and it stays in your shelf for a long, long time? Lower cost of market is what we have to deal with inventory when things happen. So especially when we purchase our inventory, right? Because we live such a in such a consumer society, right? We're all about you know, the latest and greatest, right? We're always looking at technology and things are just constantly becoming better and better and better. And usually electronics, things like that, they don't last as long as they used to before, right? Because if we're living in such a consumer society, right? The iPhone comes out every year, so that means people want to go line up to get the phone every year. So in this case, even though the iPhone itself can last up to 3 to 4 years, upon the condition that you keep it in, right? It definitely can live, have a life of at least 3 or 4 years. But because we live in a consumer society, right? We always want to be interested in the newest, latest, and greatest. Okay. So with that being said, that causes products and things to become obsolete. Eventually, over time, when you have something, especially that's progressing in technology, right? There's a better way of making this piece of glass. There's a better camera, right? There's better equipment, better operating system, right? When you have those kind of things, then eventually the older materials that you produced back then, they tend to become obsolete, or they become, you stop producing it, and so on and so forth. So with that being said, when you have those situations happen, and I'll give that example, right? The iPhone, right? They stopped producing the iPhone 10 a long time ago. They stopped producing it 2 years ago, right? So anybody that has the iPhone 10, well, if anything happens to their iPhone 10, what can they do? They can't do too much to it, right? Because they stopped producing the iPhone 10, right? And any model before that, right? So what they do is, um, you know, those, they do have some kind of holding value to it, but at the end of the day, they can't sell you an iPhone 10 for the same price as the iPhone 13. That's ridiculous. No one's going to be willing to pay for it, because why buy a previous model if it's already obsolete, it's no longer in production, it's already been 4 years past its prime time, right? So why settle for something older when you can get the same exact product, but a brand newer and greater model? So in this case, right, what happens is that the market decides that it's no longer worth the price that you purchased it for back then. So back then, if it cost you, $500, right? You can't expect the customer to purchase it for the $1,000 that you priced it originally, right? Unfortunately, you would have to either drop the price to 500, and therefore, because of the cost of materials, right? The cost of buying those phones earlier back then, right? They no longer withhold or withstand its cost, right? Because again, the cameras don't exist anymore, so therefore it drops in value, right? The glass that they produce is no longer available, it drops in value. Even the iOS, which is the operating system, right? It's not available anymore, so it's going to definitely drop the phone even more in value. Okay? So with that being said, what happens when we do that? We need to do what's called a lower cost or market, where we're going to be testing the cost of the of those products that we purchased, right? And hold them against the market. And what happens is, because of the market's going to tell you that it's no longer worth this price anymore. So you must either compare and contrast, and you're going to be testing whether what the price that you originally purchased it for is lower than what it is being sold for on the market. Okay, what the market is telling you to do, to say that it cost. Now, with that being said, right, when we figure out that the original cost does indeed is actually higher than what the market tells you, then you have to adjust your inventory accordingly. Okay, so again, the thing about inventory is that this is one of the rules that if you remember from the accounting principles, this is the only exception, or one of the only exceptions to the historical cost rule, just because we live in such a consumer society that the market forces us to adjust our inventory accordingly. Even though we originally purchased it at a price, this is the only one that allows us to bend the rules and adjust our books accordingly to accurately represent to accurately represent what we actually truly earned, okay, and what we truly spend. So in this case, we do need to change and modify the inventory and selling price to a lower value. Okay, so this is where oftentimes you will see things that are usually on sale or discounted, because they want to get rid of the items before they have to go ahead and have to do this, because it's better to get rid of the item than actually have to take a loss. Okay? So these are the 4 things that you need to know. You need to know these 4 steps, right? You need to be able to tell me how to solve for the ceiling price, how to solve for the floor price, how to solve for the market price, and last but not least, you also need to determine how to figure out the lower cost or market. Okay, so these 4 formulas, well, 2 of them are formulas, and the other 2 are comparisons. So in this case, what we're going to do is we're going to break down each one by each step. So first steps first is, you will actually be given this information, because at the end of the day, you are not the inventory manager, nor are you the profit manager. You are simply just the bookkeeper, okay? Or the accountant. So what you have to do is you need to test to see if you need to adjust inventory, right? The inventory manager is not in charge of this, okay? Because this is an executive decision that the accountant must make, okay? So in this case, we have here, you should always be given the first 6 pieces of information, right? You're going to be given the original price that you purchased the items at. Okay, usually it's by cost, okay, per item, not by total cost. Okay, and then the next column is going to be your replacement cost, which is going to be what the market tells you that it's currently at right now, and it's asking you to replace the cost by this much. This is what you normally sell it in the store for. So at $8.17 is what you are establishing your estimated selling price. Now, to get rid of that item, it's going to cost you money to dispose the items. Okay, so that's what this section is. And then the amount of maximum profit. So again, we talked about the selling price, right? You still want to get some kind of profit percentage out of it. So in this case, I want to at least still retain, even though if I have a lower cost of market, I still want to retain at least a 40% profit, which if you do multiply it, it should be $3.28. So the amount of profit will be there. And that's how much money you're going to earn from this sale, even though what you originally purchased it at. So as you can see, I originally purchased it at $5.04. I want to sell it at $8.70, and I want at least a profit percentage to guarantee that I should get at least $3.28 profit. So that's how you read this table, right? But as we are utilizing this, you are not required to figure these numbers out yourself, okay? These will be given, okay? The only numbers that you are going to be required to know is those four that we talked about: the ceiling, the floor, the market, and lower cost. Okay? So in this case, step 1 tells me that I need to solve for my ceiling price. The formula to solve for my ceiling price is going to be my selling, okay, not ceiling, my selling price minus my cost of disposal, okay? So in this case, my selling price is $8.17, and I need to subtract out my cost of disposal, which is 87 cents. So that should give you a total of $7.30, okay? So that's your ceiling, right? Now I need to figure out my floor, which is step 2. So in this case, my floor is going to be net realized value minus the amount of profit. First off, what is net realized value? Okay, well, I'll tell you this. Net realized value is the same thing as your ceiling price, right? It's the same formula, right? It's going to be your selling price minus your cost of disposal, which is your net realized value, which we already solved for as $7.30. So therefore, net realized value minus, okay, your profit amount of $3.28. So if you calculate that, $7.30 minus $3.28 is going to leave you with $4.02, okay? All right. So now that I solved for my ceiling, I solved for my floor. So the next step here is going to be determining the market, okay? So what this one is going to entail is you're going to be comparing 3 numbers. You're going to be comparing your ceiling, your floor, and your replacement cost. Now the rule of thumb here is if your ceiling price is going to be greater than your replacement, okay, and if your replacement is greater than your floor, then your replacement is going to be your market price. But for any reason that your floor price is end up being greater than your replacement, then your floor price becomes your market. Okay, that's too many confusing things, right? Let's just think of it this way. We're going to take these 3 numbers, right? We're going to compare them on a number line, placing them in order by highest price to lowest price, or however you like it. If you want lowest price to highest price, doesn't matter, as long as you put these 3 numbers in order. So obviously the highest is $7.30, right, which is my ceiling, right? My $4.89, which is my replacement cost, is in the middle. And the lowest value that I have here is my floor price of $4.02. Okay? Now in this case, when I compare my 3 numbers, what I'm going to do is I'm going to select the one that's in the middle. Okay? Between the 3. Which value is in the middle? And this is going to become your market price. Okay? So imagine you're in a room, right? You have the ceiling price, which means you have the roof. So therefore, you can't go beyond the roof, okay? And then you have the floor, okay, which is going to be you can't go below the ground, right? And then you have whatever is in the middle, right? Occupying the middle of the space, whether it's a desk, a chair, right? You want the one that's in the middle. Okay, so the highest value can't go beyond it, the lowest value can't go beyond it. You want what's in the middle. So in this case, that's exactly what we have here. when we compare our three numbers. We know that $4.89 is going to be in the middle. So that just happens to be my replacement cost. So my replacement cost now becomes my market price. Okay? And then last but not least, now that we've solved for my ceiling, my floor, and my market price, now the last step is to answer the question. Which one is lower? The original cost or the market cost? So in this case, my original cost of $5.04 or my market cost at $4.89. And it's straightforward. You also you compare, right? Which one is greater? Or which one is lower, right? Because we're trying to determine which one is lower, the original cost or the market cost. So in this case, it tells me that, well, $5.02 is definitely greater than $4.89. So that means I'm going to choose the lower out of the two numbers here. And this is going to be my lower cost of market. So because it ended up being lower than what I originally purchased, that tells me I need to adjust my inventory. Okay. Any questions in regards to figuring out the lower cost of market? Okay. Now, oftentimes, you are likely to see that you're going to have to adjust your inventory accordingly just because we live in a consumer society. We buy a bunch of products, and if we end up can't selling them, we are most likely going to be adjusting our inventory more often than not. Okay. So let's go ahead and do two more examples here to keep practicing. So the next set of numbers I have here is, right, I originally purchased something at $4.01, okay? The replacement cost is $3.92. The selling price is $8. The amount of disposal is going to cost me 40 cents, and the amount of profit is 45%, which gives me $3.62 profit. Okay? So in this case, how do I determine the ceiling price? Correct. So in this case, $8 minus 40 cents. $7.60. Okay. How do I determine the floor? Good. So in this case, $7.60 minus $3.62. $3.98. Okay, so now how do we determine what the market is?
We compare.
Mm-hmm. Compare what?
We compare the ceiling price to the floor price
Mm-hmm. One more.
and the replacement cost.
Okay, so good. So added to 3, right? Which value is going to be in the middle?
The replacement cost.
The replacement cost, let's see, $3.92. Is that greater than or less than $3.98?
It's less than.
It's less than. So is your replacement cost going to be in the middle?
Yes.
No. $3.92 It's definitely less than 398, right? We gotta place our numbers on a number line. So in this case, the highest value we have here is $7.60, right? That's already given. Okay. Which one's the lowest? What's my lowest value?
398.
So the lowest value is 392,
Or
right? So the one that's in the middle between those two numbers is going to be 398, which is your floor price. So in this case, my floor price is going to be my market. Okay? Last question, right? Which one's lower out of the two numbers? My original cost of $4.01 or my market cost at $3.98?
original?
$4.02 is lower than $3.98.
Where's $4.02? I don't see it.
I'm on the second row here.
Oh, okay.
Original cost is $4.01.
The market. So it would be, yeah, 398.
The market is lower. Okay. Right. All right. Let's do one more example. So if I originally purchased my values at $3.49, okay, and I have the replacement at $3.05, my selling price is $8.25, and my cost of disposal is 95 cents. I want a 42% profit to yield me $3.50 profit. So, how do I solve for my ceiling?
The selling price minus the cost of disposal
Okay,
is $7.30.
$7.30.
And then $7.30 minus the profit amount, which is $3.80.
Not $3.80, $3.50. So 350. Okay. So 730 minus 350.
Is I get $3.80.
Oh, you got $3.80. Okay, yes, good.
Okay, yeah.
Okay. All right. So $3.80. Okay, so now we need to figure out what is the market price.
Is it 398?
398. No. I don't know where you got that number. So we're comparing three numbers, right? The ceiling at $7.30, the floor at $3.80, and the replacement of $3.05.
So $3.05 is the market. Is the middle.
Is it really in the middle? Put it on a number line. Is that the number? Is that the highest or lowest value?
Is it 402?
402. We do not use the 402. I don't even know where you got that number.
The floor price 380. So it's 380, 730, and 305.
Mm-hmm.
So it would be 318.
it would be 380, right? Because in this case, the highest is 730, the lowest is 305, right in the middle is 380. Okay? All right? If it's always going to be the replacement cost, then why have us figure out this numbers? If it's always going to be replacement cost is going to be your market. Okay? So in this case, our floor is going to be my market of 380. Okay? So then last but not least, we need to compare which one's lower, original cost or market cost. So my original cost is $3.49 and my market cost is $3.89. Which one's lower? $3.49. Good. Excellent. Any questions? We're going to keep practicing calculating this in our exercises, okay? But for now, any other questions? Okay. So what does it mean? So if I have to figure out, right, that if me calculating the lower cost of market and I end up getting a different value than what my original cost is. So if my market value, right, was lower than my original cost, then what I have to do is I actually have to use one of these methods, the direct or indirect method, to adjust my inventory accordingly, okay? Now, both of these methods are used, okay, to adjust inventory. Okay, they both are correct. They both are accepted in the accounting principles, okay? However, let's go ahead and look at both scenarios on how we would approach each one, okay? So, for example, the direct method, what happens is it allows you to adjust your inventory. However, you do not recognize a loss. What happens is you actually just pretend that you end up costing it through the goods sold. So instead of recognizing that you actually had a loss, you kind of sweep it under the rug and put it in where like you pretend that you end up selling those items instead of taking a loss. Okay? And of course, for the indirect method, what this allows you to do is it allows you to adjust your inventory, but you end up creating an account to represent the loss on the inventory items. Okay? So again, okay, I don't recommend you to use the direct method just because, again, you're not really, it's definitely, you're taking a loss, right, for the, what do you call it, taking a loss because you lost it due to the market, right, adjusting to the market. It's definitely a loss for sure, and it's just as part of a person who does, you know, the inventory management and things like that, right? It is that I don't recommend you to use it just because you don't want to sweep things under the rug and put it into the cost of goods sold. Even though it is a correct method and it's a valid method, right? It's just recommended that you should just end up recognizing the loss because at the end of the day, when you do file for your taxes, you know, you are allowed to take losses, okay? It's part of the process of doing business. You are allowed to take losses, okay? But in this case, I'm going to show you both methods here, okay? So let's start with the direct one, okay? So again, it will depend on what kind of inventory you have. So again, we're focusing on periodic inventory, right? So if you have periodic inventory and you're using the direct method to adjust your inventory accordingly, right? So in this case, we purchased 1,000 units at $1.25 each on January 1st, 2020. And of course, at the end of the year, okay, usually you adjust at the end of the year because, again, consumer society, you're always going to have something new at the end of the year, right? Think about cars. Okay, you're always going to have a newer, later, greatest model, typically a year later. So typically you would do this adjustment entry towards the end of the year, but you can do it on a month-to-month basis if it's something that you think that, again, it's a product that loses its value pretty quick. So again, at the end of the year, right, you go ahead and do your adjustment, lower cost of your lower cost calculations, and you determine that at the end of December 31st of 2020, you end up getting a loss due to the market, okay? Because then the market cost tells you, right, that it's now $1.15 for each one. So in this case, looking at this table, right, on January, we purchased those mugs for a thousand of them for $1.25 each. Now the market tells you at the end of the year that, hey, this mug, the model of it doesn't exist anymore, or maybe the color stopped being produced, whatever reasons, it has lost 10 cents in value. Okay? So therefore, right, these are my numbers when I look at purchasing them. So then I originally purchased them in January for $12.50, where it's telling me now, as of December, it's worth $11.50. Okay, this is what it cost me. Okay. So in this case, what I'm going to do is I do my normal periodic inventory conversion, right? However, after that, then this is what I have to do, right? I now need to adjust my inventory accordingly because now, right, I know instead of journalizing that I acquired all the inventory, right? What happens is I do have to do inventory, and then I'm going to put again the loss into the cost of goods sold. So in this case, what I'm going to do here is I'm going to compare and contrast, right? What is the difference in amount? In this case, it's $100 difference. So that's exactly what I'm going to do. I'm going to recognize the lower cost of market at $11.50, and what's going to happen is I'm also going to be recognizing it at that lower cost price. Okay, I'm not going to even budge to tell me that there is a $100 difference, right? So when I do my conversion entry, right, I use it and I convert it at the price it is worth now. Okay, any questions here? So instead of journalizing, right, that I'm going to increase my inventory, right, because I'm doing my conversion entry, right? Once I've done that, I'm going to also do this part because I also need to take out this inventory right here because it is not worth $12.50 anymore. It's worth $11.50. So in this case, I'm going to take it out in my cost of goods sold. So instead of recognizing my entire inventory at $12.50, right, when I do my purchase, when I do my conversion entry, I recognize it at the market price or what it's worth right now. Right? Any questions? Okay, no? Okay. So what's the difference between that one and the indirect method? Okay, so the indirect method right here is the same scenario, but what I'm going to do is when I do that, I'm going to convert it, my numbers in here, exactly what I was like doing my conversion entry, right? But this time, I'm going to be recognizing for the real amount, okay? And then I'm going to adjust and take a loss, saying that I have a loss due to the market to the decline of inventory. And this is going to create an allowance for the reduce of the inventory, okay? Which is going to be, right, the difference between the two, which is $100. Okay, so again, yes, you will have your cost of goods sold if you did sell it, if you did sell your items. But in this case, I didn't sell an item. All I did was just, obtain the inventory. And no one bought any of them. So right now, I'm still at 1,000. Okay, but this also reflects to when you do purchase your inventory, right? And you do wait till the end of the year to adjust, right? This is us recording it at what it is worth now compared to back then. Okay? Right? So again, when we're doing the direct method, you just recognize for what it is worth now. Your indirect method is going to recognize the full amount. However, you're also going to recognize the loss that you have on it. Okay? Right? Now, in this case, I am not going to test you on this section just because, again, this involves with the inventory manager. So this is actually technically not really your business to be doing this, but it is because you are the bookkeeper that you should at least know how to journalize it, and this is it right here. Okay? But I'm not going to test you on it. It is extra knowledge, okay, of what you need to do when you come across having to deal with the inventory that needs to be adjusted. Okay? And of course, I have perpetual inventory in here as well, but we won't learn perpetual inventory until chapter 7 and 8. So that's just there if you want to go back to this chapter. Okay? So chapter review, right? Things that I taught you in this class that I want you to get away with is going to be just calculating the lower cost of market. Okay, the 4 steps to calculate the lower cost of market. Okay. So, any questions?
No.
So let's go ahead and do the example here. Right, so on the the most left column we have here is going to be the items that I purchased, right? This is what I originally purchased each item at. The next row is going to be the replacement cost, right? Then we have the selling price, the cost of disposal, and the profit margin. Okay, or in this case, yeah, the profit amount, right? No profit percentage just because it just tells you how much you want out of the money. So in this case, the most important number that you're looking at is what the actual profit amount is. Okay? So let's practice. So number 1 here, I bought some chips, okay? They were 89 cents a bag. Now they're telling me it's 49 cents a bag, okay? I sell them at the store for $3.99. It takes me 15 cents each to dispose them, and I want the amount of profit to be $3.05. So once again, maybe it's a limited edition, flavor of the month, experimental chips, okay, that isn't going to be in production any longer. So here it is, right? How do I solve for the ceiling?
The ceiling price is the highest, right?
Yes.
So it would be $3.99.
Okay, so in this case, ceiling, it's not just $3.99. That's the selling price.
So it's $3.99 plus 89.
No.
Oh,
In this case, the ceiling price is going to be selling price minus the cost of disposal.
cost of disposal. Okay, so that would be 384.
Okay. All right. So then the floor price. How do I calculate the floor price? Ceiling price minus profit amount. So $3.84 minus $3.05. It's 79, right? Because you got 84 minus 5. Okay. So then I have to compare three numbers. I need to compare the ceiling, the floor, and replacement. Which number is in the middle?
49 cents.
All right, let's put this on a number line again. You got $3.84, right? You got 79 cents and you got 49 cents. Which one's the highest value? 384. Which one's the lowest value? 49 cents. So out of those two numbers, which one's going to be in the middle?
79.
It'd be 79 cents, okay? Because your replacement is 49 cents, which is lower than the floor. Okay? So in this case, your floor becomes your market. So now, last question asks here, which one's lower, original cost or market? So original cost of 89 cents versus 79 cents. Which one's lower?
79.
79. Okay. Okay, let's do the next one, okay? The next one, I bought cups for $2.59. The replacement cost is $2.49. I sell these cups at $8.99. The amount of disposal is going to be 75 cents. And then the amount of profit I want to get from each cup is $5.84. So in this case, how do I solve for my ceiling?
$8.99 minus 584.
Not 584.
Oh, 75 cents.
Yes, ceiling is selling minus cost of disposal. So $8.99 minus 75 cents is going to yield me
8.24.
$8.24. Okay. Now I need to solve for my floor.
The ceiling price minus the profit amount.
Good. So in this case, it's $8.24. Okay. Minus $5.84.
$2.40.
$2.40. Okay. So now let's compare, right? My ceiling of $8.24, my floor of $2.40 compared to my replacement cost of $2.49.
249.
$2.49, right, is going to be my market. Okay. So last but not least, compare. which one is lower? Original cost of $2.59 or my market cost at $2.49?
$2.40.
To not 40. My market is $2.49.
$2.49.
My market of $2.49 is lower than $2.59. Okay. Let's do another one. Okay. So if I decided to buy some shirts and it cost me $1.98, they tell me that it's now worth $1.66. I sell them at $4.99. To dispose of them is going to cost me 22 cents, and the amount of profit I want to get out of it is $2.99.
Is it 477?
So we're going to take my selling price of $4.99 minus my disposal to get $4.77. Good. How do I solve for my floor?
Is it 477 minus 299?
Yes. Right? You take your ceiling minus the amount of profit.
Is it 122?
One,
78. I tried doing it in my head. I was wrong.
no worries. Okay. So 178. So now I need to compare my ceiling, my floor, and my replacement. So I have 477, 178, and 166.
178.
178, right? It's going to be in the middle. So, last comparison is which one's lower? My original cost at 198 or my market cost at 178?
178.
Yes, 178 is lower. Okay. Another example here is I bought pants for that cost me $5.25. It's telling me now it's worth $4.98. I sell these for $14.99. It's going to cost me $1.85 to dispose, and the amount of profit I want to get out of it is $8.15. Okay. How do I solve for the ceiling?
$14.99 minus 185,
Mm-hmm.
which is $13.14.
$13.14. Okay. What is?
Minus
Go ahead.
$1.15. I mean, $8.15.
Okay. And
$4.99.
$4.99. So let's compare, right? I got 13.14, $4.99, and $4.98.
$4.98.
Is $4.98 greater than $4.99?
Oh, no.
No. So in this case, $4.99 is your market. So now last but not least, let's compare. Is my original cost of $5.25 lower than my market of $4.99?
No.
No. So that means $4.99 becomes my lower cost of market. Okay, the lower one is $4.99. Right? So I bought some hats for that cost me $2.58. Okay, is now telling me that it's $2.05. I sell these hats for $9.99. To dispose them cost me 59 cents, and the amount of profit I want to get out of it is $7.49. So in this case,
$9.40.
okay,
And $191.
okay. So what's in the middle? My ceiling of 940, my floor at 191, or my replacement at 205?
$498.
205.
498. Where'd you get 498? Where? Oh, that's the previous one.
Yeah, sorry.
No worries. So in this case, $2.05 is in the middle. So let's compare. Which one is lower? My original cost of $2.58 or my market price at $2.05?
205.
205 is lower. Okay. Couple more examples left. So if I decided to buy some toys, it cost me $1.05. It's now telling me that it's worth 98 cents. Okay. The I sell these toys at $6.99. To dispose them is going to cost me 11 cents, and the profit I want to get out of is $5.81. So in this case,
688.
$6.88.
107.
107. Okay. So let's compare and contrast. Okay. We have 688, 107, and 98 cents.
107.
107. Last but not least, which one's lower? 105 or 107?
105.
105, right? My original cost is actually lower. Okay. Two more. If I decide to buy some pens that cost me 78 cents, all right, and they tell me that it's worth 33 cents now, right? I sell these pens at $2.99, right? It's going to cost me 7 cents to dispose, and I want a $2.24 profit.
$2.92.
Yep, 2.92. Right, there 68 cents is given to you.
And then it would be 68 again.
68 is definitely going to be there, right? Because which one's lower?
7. Oh, 68.
$68 is lower. Yes. Okay. All right. Last but not least, right? We have a laptop that we originally buy at $584.60. They tell us that it is $562.17. You sell these laptops for $849.99. To dispose, it's going to cost you $129. And you want $127 profit. Okay, so in this case, my ceiling is going to be
$720.99.
yep, 720.99. Good. Floor,
$603.99.
$593. Close, 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 close. Okay, and then compare which which one's in the middle. Okay, so 720.99, 593.49, or 562.17.
593.49.
593. So last but not least, which one is lower? The original cost at 584 or my my market cost at 593.
584.
Right, my original cost of $584.60. Okay. All right. That is it for today. All right. Any questions?